Hi, I'm going to talk to you today about investing and how fees can make a really big impact on your returns over the very long term. And I'm doing that via this graph, which is perhaps a little confusing to start with, but I'm going to walk you through it. So I want to draw your eye first to the very top solid green line. And starting off in 1970, it assumes $1 is invested in the S&P TSX Composite Index, which is a benchmark index of Canadian stocks. You can view it as the Canadian stock market. And that $1 grows over time in an uneven fashion. And by the end of 2014, it's worth about, well, just a little bit more than $50. And that assumes that you've just got the index's return and there are no fees are involved whatsoever. Now, reality is, if you want to buy an index fund, it's going to charge you a fee. Usually it's a fairly small fee, but a fee is going to be involved. And so that's where these other lines come in. And on the left here, I show results for the index is a return less a certain percentage annual fee. A 0.25% annual fee is perhaps something that an index investor would be used to, and all the way down to a very hefty 3% annual fee, which would be charged by pretty expensive actively managed funds. But let's see the result just of that 0.25% annual fee. That still makes a difference, which might be a little surprising. It makes a fairly big difference, not huge, but instead of earning just above $50, you're earning just below $50. Well, a 0.5% annual fee brings you down to earning, at the end of the day, just above $40. A 1% annual fee, which is charged by some index funds out there, brings you down to about $35. Now, the higher fee funds, like the active funds, may charge as much as 3%, or more commonly in Canada, 2% is more common for an active fund. And here, the implicit assumption I'm making is that the fund manager isn't particularly good, and they only manage to obtain the index's returns on a before fee basis, but then of course they're charging their fee on top of it. So if that's the case, then that 3% fee, your portfolio only grows to about $15, hardly anything. A 2% fee, you're way down at just above $20. So more than half off. So enjoy a retirement that's maybe not so flush with cash. So this, and of course, this is, if you happen to find an index fund that's charging 3%, this is sort of what you can expect. Pretty miserable time. Now, this is of course why index investors are really looking to cut their fees, and most index funds charge very small fees, the better ones anyway. So the idea is, look, we're going to give up on trying to beat the market, but we're going to just reduce these fees significantly. And even for active fund investors, there are lots of funds that are cheaper, so you can opt for the cheaper active funds, and some managers there are very good. So that's something definitely to keep in mind. And I want to sort of drive home the point that a 3% annual fee might not sound like much unless you've looked at a graph like this, but it really is huge, and it's hard for even some of the most skilled managers to overcome that sort of fee. So where possible, I would advocate, certainly index investing, picking a lower fee fund, and with active investing, pick managers, good managers, who don't charge as much. And they are out there. They just take a little while to find. I'm going to proceed in future videos to talk about taxes and inflation and other items that you want to watch out for, but I'm going to leave it off here for the simple sort of long-term impact of fees. I think this graph really sort of drives the point home that, hey, where possible, reduce your fees. So thank you, and until next time.